Great, and broadcasting in about 20 seconds.
Thank you for joining us, everyone. We'll start momentarily. While you're here, please share where you're dialing in from in the chat. Hello, everyone. While you're here, share where you're dialing in from in the chat. We would love to know. And we'll start in just about 1 minute. Again, thank you all for joining us. We'll kick off the event now. First and foremost, we're actually wondering, how are you feeling? We're going to ISIS, a part of our NASDAQ team here. We'll share a poll, and we're hoping that you all would be able to fill out the poll for us. How are you feeling? We would love to see. So thank you for joining us today. For those of you joining us for the first time at the NASDAQ Entrepreneurial Center, we're a nonprofit organization that provides invaluable resources for founders and leaders to learn, make connections, and grow. As a center, we are here to help them on their journey to drive innovation and ultimately to improve the world. For those of you returning, welcome back. We also want to give a shout out to our sponsors who make all of this possible. NASDAQ, Lehigh University, Bank of the West, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft, New Zealand Trade and Enterprise, NASDAQ Educational Foundation, and BPM. We're proud to be launching our new series of learning webinars, as well as mentoring and coaching circles led by industry experts from our NASDAQ Center community. These new programs are designed to help you solve your most pressing issues while facing immediate changing circumstances and adversity. Thank you all again for joining us. We're so grateful and happy that you're here. We will start financial modeling, get smart about real revenue costs. So without further ado, please join me in welcoming our special guest, Lauren Taylor.
Hello, everyone. Good morning. Thanks so much for joining us this morning. If you haven't already, I'm going to ask you to please open 2 of the documents that have been shared with you. We're going to take a look at these during the presentation, and I just want you to have them open so that you can easily click over to them while we're working together. The first one is the pricing guide, and the second one is the pro forma. There's another document that has been shared with you that's a little bit longer document. That's the SaaS financial plan. We're not going to work with that today, but I wanted to offer that to you as more of an advanced pro forma so that you can take a look at some of the larger expectations that will be that you'll be thinking about down the line as your startup grows. Thanks for more. I'm sorry. I'm gonna keep moving along. So I appreciate, I won't be able to tell if you're all with me, but if you have any questions, you can throw those into the chat, and then Isis and Maria can ping me and let me know that I can pause and respond to those. The other thing that I want to mention is that we'll do a Q&A at the end. So if you have clarifying questions, please throw those in the chat. If you have questions where you want to go a little deeper on something that I'm talking about or that I've shared, please save those for the Q&A. Okay. So I want to start today with an overview, but I also want to share a framework or lens for processing what I'm going to be sharing with you today. So the first thing I want to say is that everyone here is working from their own understanding of these concepts, myself included. And you could leave here today and look up everything that I'm going to share, and you'll find 10 people with a completely different perspective, and 10 people who share my perspective, and 10 people who have no idea what they're talking about and are still sharing their own perspective as if they do. And that's fine. That's great. So you should take it all in and compare your sources, and then think about which ones are most applicable to what you're doing and what you want to be doing. If I share something and you think, I learned this a different way, that's great. What you've learned is no less valid. And I'm not saying that your way is wrong. This is just another data point. I love data, and I hope you do too. The other thing that I want to share is that even though we're talking numbers today, we're not going to dive deep into any big mathematical equations. So if you don't feel confident in your personal accounting, don't worry. You can still feel confident in your business accounting. I grew up feeling really slow in math, and it wasn't until I became an entrepreneur myself that I realized how fun and empowering doing your own books can be. So I hope that what you learned today helps you feel confident and really appreciate your business and its potential to grow. The last thing I want to say is just to expect unfinished business. So this is a 1-hour workshop. It's not an MBA. So I'll stick around afterward and answer questions. Again, we won't be able to take questions during the presentation unless they're just to clarify what it is that I've said. Okay. A little bit about me and my background. I am the founder and managing partner of Zero Gravity Agency. We are a brand consultancy, not a branding agency, a brand consultancy, and we work with clients on product development and marketing. So we work with clients at every stage of their product's lifestyle with a focus on traction and revenue. Many of our clients are in that sweet spot where they need traction in order to attract VC, but they need money in order to get that traction, and they can't scale without that. So we step in to support them through this period. And when we see a great opportunity to support a founder with a product we know we can move, we'll actually invest in that product, often working for equity, and we can get the product the traction it needs to move that client toward the right VCs. I'm an angel investor myself, and my experience helping founders get traction has given me pretty good insight into what to invest in. I'm a due diligence lead for Pipeline Angels, which is the investment group with which I work. And if you'd like to learn more about fundraising, or you'd like to practice your pitch and get feedback, I'm happy to schedule a time to talk later. So please follow up with me by LinkedIn, but please remind me that we did this class together. If it's just a random ask to connect, I will likely not know who you are and I won't accept, but if you let me know that we did this class together, I'll be really excited to check in and hear more from you. So the first thing I want to jump in today is around TAM, SAM, SOM, and sizing the market. Just so that we're all on the same page here, sizing the market is something that folks are often asked to present in their pitch deck. So they have a slide that includes TAM, SAM, and SOM. What is this? TAM is your total addressable market, SAM is your serviceable addressable market, and SOM is your share of market or serviceable obtainable market. Okay, well, what does that really mean? TAM, like let's say we take an analogy like fishing. TAM refers to the value of all of the fish in the sea. SAM is the value of all of the fish within casting range of the dock you fish from. And SOM is the value of the number of fish that you can reasonably catch within the amount of time, energy, and bait that you can allocate to fishing. And so I'm going to go through that one more time. TAM is all of the fish in the sea. SAM is the value of all of the fish within casting range of the dock you fish from. And SOM is the value of the number of fish that you can reasonably catch within the amount of time, energy, and bait that you can allocate to fishing. Okay. Sometimes people make the mistake between their target audience and their target market. So here, when we're talking about the target audience, these are the people that have the problem you're trying to solve. They know they have the problem. They've been trying to solve it some other way, and they've been paying an equivalent amount or more, and they're not happy with their current solution. That's your target audience. That's also different from your target demographic. Your target demographic might be women ages 35 to 55 who are in dual income households. Okay, so target demographic, target audience, those are different from what we're talking about here. This is the market sizing. And honestly, it's really more of an art than a science. So I want to think about something from a few different perspectives. Let's take a look at something like Uber. So Uber's TAM. If you think of Uber as a taxi company, then your TAM is all taxi business globally. But today we think of Uber as more than just a taxi company. Uber is a transportation business. And there you're looking at the global transportation industry. So, after Uber launched its taxi replacement, then they're launching Uber Eats, Uber Freight. They're launching a lot of different verticals within transportation. So you could think about the TAM of Uber in both of those different ways. Then you want to think about something like Facebook, right? Is Facebook a social platform or is it an ads platform? Either way, what's interesting is that there's no analogous service it's replacing. Unlike Uber, where it's replacing taxi, Facebook, maybe it was replacing another social media, but there was really nothing like it at the time. So their TAM becomes a total abstraction. And what then makes the rest of the market sizing challenging there is SAM and SOM are based on TAM because they're a percent of that pie. So you want to think about what your market is today, what your market is tomorrow, and then think about SAM and SOM as part of that. And when you have no market, when there's nothing that it's replacing, you just want to recognize that you're going into this as an abstraction. And that's fine. I want to give you a couple of examples of how you might size or how an investor might size the same market for the same product differently from different perspectives. So example one, we've got an entrepreneur with a new point of care test for Lyme disease, and they might use this framework and show a slide or two describing the market in this way. Here they've got their TAM as the US market for point of care testing, and it's worth approximately $6 billion. They've got their SAM, which is Lyme disease treatment, and that generates about $1.5 billion each year in the US alone. And then they've got their SOM, and here they're talking about testing for Lyme disease, which is about half of the treatment market, or about $750 million. Okay, so one way that we might think about the TAM, SAM, and SOM for that entrepreneur. Same product, same entrepreneur. We could think about it another way. Here, the TAM is Lyme disease treatment, which generates $1.5 billion each year in the US alone. Here, the SAM is testing for Lyme disease, which is about half of the treatment market, or about $750 million. And then the SOM is 50% of market share, which is about $375 million. Why would I do it differently? Well, I want you to think about, how am I going to capture 50% market share? As an investor, I'm going to have that question for you. What is your plan to capture 50% market share? And how did you get to that $375 million? You want to be able to justify that explanation. And so you might think deeply about what it is that you're going to do. What is your defensive moat? What is your in? And how long of a time frame is that going to play out over? And then a third example, and this is my realistic brain really looking critically at what it is that he's sharing. What I'm saying is TAM here is testing for Lyme disease, because this product specifically is just a Lyme disease test. So to me, your TAM is testing for Lyme disease. That's $750 million. Your SAM here is the percent of Lyme disease testing that's done at point of care facilities. So right now, If your test is for Lyme disease done at point of care facilities, that to me is your SAM. And then your sum might be the number of point of care facilities managed by, or might be determined by the number of point of care facilities managed by healthcare conglomerates. So for me, that's way more realistic. Why healthcare conglomerates? Because going into a B2B relationship, if I am interacting with one client that has one location versus one client with 50 locations, it's going to help my product get out there a lot faster if I'm trying to land that one client with 50 locations. So that's where I'm starting with healthcare conglomerates. Okay. So yeah, it's way more realistic, but is that compelling? Right? Am I showing the big dream? So investors are going to give contradictory advice here. They want you to share the big dream and they want you to be realistic in your market sizing. It's, like I said, an art, not a science. But be ready to articulate what your numbers represent and how you calculated them. And be ready for an investor to call BS if you're not able to justify what it is that you're sharing your market sizing around. Okay, so let's take a look at some business model dilemmas. If you've decided on your TAM, SAM, and SOM, the next influential decision here is what kind of a business model or financial structure you're planning to use. So how are you going to make money, right? Are you B2B or are you B2C? Is it a monthly subscription or a one-time download? Are you working e-commerce or do you have a brick and mortar location? And what your business model canvas doesn't not necessarily tell you is really around pricing. And there are a lot of ways to think about pricing. So here, in terms of price, my first question might be, what is the problem costing people? And what is the return on investment they get from your solution? For instance, if you have a software that replaces Jira, Trello, and Monday, that's great. But how many people have all three, right? They all do the same thing. Versus if you have a software that replaces Jira, Slack, and QuickBooks. Now you're replacing something that's worth a lot of money, right? Also, what is this weird software and why would anybody need it? But that aside. So the value of the savings is going to also vary by who's using it. If you have a software that will save 5 people 5 hours a week, and those people are being paid $15 an hour, is that a significant savings for them? Versus if you've got 5 people, 5 hours a week, and those people are being paid $250 an hour, then do you have a significant savings? More so, yeah. So you want to think about all of those things as you are considering the price point. Next, oh, there we go. If you're an enterprise SaaS, you might be selling to a large company where all the expenses above 5,000K have to be approved by corporate. So in that, you might want to price it below 5,000 a month versus having like a $60,000 a year contract that has to be paid up front, right? You need to know what the purchasing behavior of the people in your industry already looks like, because nobody's going to change the way their company budgets in order to buy a product that no one's ever heard of or used, and that's you right now, right? So this is an important step in your customer discovery process, learning how they currently make decisions, because these purchases are going to determine your business model. So you need to go out and talk to customers pre-product and figure out what it is that, how it is that they already buy, right? So enterprise SaaS might be done in one way. Nonprofits, if you look at how a nonprofit budgets, nonprofits are often budgeting 3 to 5 years out because they're on a grant cycle. So you're going to have a very different sales relationship if you're developing a product for nonprofits. Are they doing annual or quarterly budgeting? Of course, they're doing both, but are they approving spending annually or quarterly? And then you want to think about what are all of the associated fees, not just the recurring fee. So is there an onboarding? Is there a setup fee, et cetera? I also always want to think about testing and how I'm going to test the price point. So let's say you have a subscription box and you're planning to sell that and you've got it on a 4 or 6 box subscription per year. How are you going to figure out whether or not that works right? If you have a sales cycle that lasts 1 year, that's really challenging to test. So how can you reduce that to make smaller tests and make sure that the price point is as high as it can be to reach the largest number of users possible? So determining your price, we could do cost plus. So the cost of the product, how much it costs you to create, plus whatever margin you're going after. You could think about it as competitor based. So what are all of your competitors pricing their product at? You can think about A/B testing. So early on, A/B testing might be just running ads at 2 different price points and seeing which price point is more appealing to which demographics and which demographics are most valuable. The one that I want you to really think about, though, is value-based pricing. So let's take a look at value-based pricing. And here, what I'm going to have you do is go ahead and pull up the document that's been shared with you. And this is the Lauren's Pricing Guide. So this is a pricing guide that I use, that I share with clients, and that clients share with potential customers. I want to just walk through what each of these fields represent and give you some examples. And then you can go ahead, make a copy of Lauren's pricing guide for yourself and share and fill in the examples for your own product. But I'm going to give you some instructions on that. So pause, don't go in to fill it out yet. I want you to listen to my instructions first, and then I'm going to give you 5 minutes to go in and fill it out yourself. Okay. So here in field 1, buyer's anchors, you're going to write down the things that people will think about when they first encounter your product, right? You want to use the left side for things that someone might use in place of your product, and the right side for things that they might use alongside it. So substitutes, what they might use instead of you, and then complements, what they would use alongside you. So as an example, let's say that our product is Airbnb. My substitute might be hotels tonight, and my complement might be enterprise rent-a-car. Okay. In field 2, buyer's cognitive system, I want you to write down the snap judgments that someone might make about your product, and then what they'll think after a little bit deeper analysis. So in my Airbnb example, my intuitive statement might be an anticipation of a reward. So with Airbnb, wow, cool, I can have a more authentic local experience instead of feeling like a dumb tourist. But on the rational side, after I think about it a little bit more, I might start anticipating risk. What if this place is in a bad area of town? Will my stuff be safe at these people's house? Is it weird to sleep in someone else's bed? Can I get a refund? Right? So those are the questions and more rational statements that somebody might ask themselves after diving a little bit deeper. In field 3, we've got our value-based prototype. And here I want you to visualize your product's perceived value. And this might be heavily influenced by your substitutes and complements, right? So if your product replaces something that costs $200, its perceived value likely won't be higher than that unless it gives additional benefits beyond what it is that it's replacing that increase its value to that potential user. So with Airbnb, I might want something that's cheaper than a hotel and more expensive than a car rental. In field 4, we have our assortments. Here we're going to identify how broad of a market we're targeting. First, we've got our horizontal assortment. And what we're looking at here is really the different use cases. So each segment is a different use case for your product. And that use case has a specific user for whom that use case is really important. So with Airbnb, our segments might be business travelers, digital nomads, millennials on vacation, right? Then we have our vertical. And vertical might be something much more related to the socioeconomic status of the demographics that you're working with in the different segments above. So here we've got good, better, better, and best. And we might think about in terms of an Airbnb vertical here, a shared apartment, a shared house, a solo apartment, and a solo house as our good, better, best. Okay. So right now I want to take a pause. I want you to take 5 minutes to make some notes in your copy, but I have an instruction for you. If your last name begins with A through M, I want you to start with sections 1 and 2 on the left. And if your last name begins with N through Z, I want you to start with section 4 on the right. For both groups, I want you to make section 3 your last section. Okay, I'll say that one more time. A through M, please start with sections 1 and 2. N through Z, please start with section 4. Everyone, please make section 3 in the middle, the last section that you're going to fill in your notes on. Let's take 5 minutes. I've got 10:25. At 10:30, we'll come back and take a poll. With my pricing guide, please make a copy for yourself so that you can fill in the details. It's fine for you to have your own copy that you write in and keep your notes. Okay, so with your prospective company, this is the price for your own product. So if you have a product in mind that you're thinking about that your company is going to be offering, that's what we're looking for the price here. In terms of complements, the complement is the product that people might use alongside your product. So Priya, if you want to share a note about what your product is, I can maybe give you some ideas about what complements. Great, e-lessons for artists, perfect. So that might be art materials then. A complement might be the art materials that they would specifically be using for the types of lessons that you're giving. So let's say that you're doing a live watercolor demonstration, it would be watercolor paper and watercolors. That would be a complement that immediately comes to mind. So something else that they're going to be using alongside or likely to be using alongside your product. We've got about 2 more minutes. Okay, 1 more minute. So if you haven't gotten to section 3, your value-based prototype, go ahead and start filling that in now. Again, the cost is how much it costs for you to make it. The price is what you would offer it for. And the perceived value is what your audience perceives the value of your product to be. Okay, we're going to go to the poll. So when developing a pricing plan, do you find it best to consider the buyer's anchors and cognitive systems first? Or do you find it best to consider horizontal and vertical assortment first? Or do you feel like considering either is not really relevant when you're setting your own prices? Okay, great. So it looks like most people found it best to consider buyer's anchors and cognitive systems first, but a significant number of people still find it best to do horizontal and vertical assortments first. And everybody is considering these things when setting their prices, which is great. I really appreciate that. Just to give you a little sense of what I'm thinking about as an investor when I'm looking at what it is that you're sharing. So when I look at what it is that you're sharing, I almost always assume that the founder considers themselves the buyer first. 75% of the people that I work with are thinking about themselves as being a target customer for the product that they're putting out there. So when I look at who is the buyer in 1 and 2, I'm thinking that you're thinking that you are. And when I look at who is the buyer in number 4, because you've had to lay out 3 different demographics and 4 different socioeconomic stratas, I understand that you are really thinking more about the diversity of buyers. And so for me, it's really important that you have thought about number 4. So whether or not you start with 4 or 1 and 2, both of those are going to bias your value-based prototype. And what I want to know as an investor is that you really thought about your horizontal and vertical markets, because that tells me that you're really thinking not just about yourself, but about your potential customers. But what I want you to do, no matter whether you start on the left or start on the right, is to take this sheet to 10 other people and find out what they use instead of you, what they use alongside you, what segment they fall into, and what other segments or use cases they might identify. What are their initial excitements and what are their initial reservations? Then have them share what they see in field 3. And when you have this information from a broad demographic of people, you'll have much more accurate information to inform your overall pricing strategy, which is then going to inform your pro forma. Okay, so before you go to this document and make a copy, I'm going to give you some instructions. So again, I want you to make a copy of this for yourself so that you can enter your own numbers. And what I want you to do is to duplicate the second tab 2 to 3 times. I recommend that you do more than one of these and to look at how your assumptions might play out. So this is a pro forma document. And what does that mean? It means that we have a really basic financial projection in here that includes everything here on the left. So the price per unit sold, the quantity that you sold, and the revenue that that brought in year 1. You're not going to see sales growth until year 2 because it's a measurement of year-over-year growth. You've got the cost per unit. That's the cost to you. And then you have the cost of goods. I'm sorry, the cost per unit is not the cost to you, pardon me. The cost per unit is for one of these things that you're producing. And then you have the total cost of goods sold. So you might have made many more than the number of goods sold. So the cost of goods sold is just the ones that you've sold. Then you've got your gross profit margins. You've got then your operating expenses. And these then become your total fixed costs. So, and then we can go down to net profit margin, and cumulative profit. There's a document here, and you can use your own. So please, again, make a copy of this document for yourself. And then you're going to duplicate tab 2 to 3 times. Because I'm going to have you make multiples, not right this moment, but going forward. So here what we're looking at is that we want to calculate the estimated revenue projections for your business. And we call that pro forma forecasting. We want to use realistic market assumptions and not just numbers that make you or your investors feel optimistic. So again, we want to do our research and speak with experts and accountants to determine what is normal, what's an annual revenue stream that's realistic, and we want to estimate conservatively internally. You want to estimate your total liabilities and costs. Your liabilities are loans and lines of credit, and your costs are things like your lease, your utilities, employee pay, insurance, license permits, materials, taxes, etc. So to create the first part of your pro forma, you're going to use the revenue projections from step 1 and the total liabilities and costs. And here, because we've already determined from your last exercise your price per unit sold, that's what's going to go here in that first section, where the price per unit sold is already determined here as $100. You want to think about what your price per unit sold is going to be. Okay, so I want you to again take 5 minutes to make some changes in your copy to see how the numbers influence one another, starting with the price that you've just set. And then after that, you're going to be asked to make some hypotheses. How many you'll sell per year, right? If you said earlier in your slide deck that your serviceable addressable market was 50% of this amount of the market, that should be visible then in your pro forma. You should be showing how it is that you're getting to that market share amount by whatever timeline you're trying to justify. So whether that's a 5-year timeline or a 1-year timeline or beyond. Okay. Next, you'll have to make some hypotheses about that will influence your outcomes. So let's say you have an enterprise SaaS product. You can use standard contract value as the price per unit sold. Let's say you have a B2C app. Okay, I want you to check out tab 3 if you have a B2C app. Tab 3 has some monthly revenue projections, so you can see the differences between how the two are calculated. A physical product versus a digital product, and how we might think about those two differently. Okay, so the things that I want you to take a look at: price per unit sold. You can mess around with that. Quantity sold. Determine how many of them you're going to sell in year 1. The year-over-year growth, and how are you going to drive that? A lot of people think like, oh, I'm going to go viral. Oh, congratulations, that's awesome. As an investor, I want to know how it is that you're planning to go viral and what evidence you have that suggests that the product's going to do that. And then we're looking at the cost per unit and your operating expenses. These are oftentimes the most expensive operating expense are your employees. So how many will you have? How many will you need? For what? When? What impact are they going to have on your revenue? Okay, let's take 5 minutes. Go ahead and make some changes in your copy of the document And when we come back, we'll do another quick poll. It's 10:39, so we'll have until 10:44. Yep, so operating expenses would be things like your lease on the space. It could be the computers, it could be software, it could be the perks that you are offering employees. It could be your utilities, insurance, licenses, permitting, the materials that go into creating your product. So all of those could be operating expenses. If you are not going down the route of seeking funding from investors, awesome. You are the investor. So as a solopreneur, my framework is to think of myself and what I want to see, how I want to see it rise, and what level of pressure I'm comfortable putting on myself in terms of the timelines that I want to see that IRR. Yes, employee salaries are definitely included in operating expenses, and often they are the most expensive of our operating expenses early on, especially because we really encourage people not to go out and rent a space, not to make major investments in unjustifiable costs. So we want you to remain as lean as possible for as long as possible. One of my favorite founders has not taken investment, and that is Sarah Blakely of Spanx. She is just such a powerful founder and a great inspiration. She has an amazing masterclass that I really recommend to first-time founders, especially those who aren't going to take investment. She has really great perspective on what to do and why and how. She also worked very lean. So as an investor, if somebody like Sarah would have presented their process to me, I would have said, yes, let's do this right away. We've got about 2 more minutes. One more minute. Anya, they should have auto-populated. So there might be something there, and I can take a look with you after to troubleshoot what's going on there. Okay, so let's go to the polling question. When hypothesizing about my company's future, I find it most difficult to imagine the amount or quantity of goods that I can realistically sell, the trajectory of sales growth and how I'm going to drive it, or my operating expenses. Oh, it's neck and neck. Great. So it looks like for most people, it was the amount or quantity of goods or services that they can realistically sell, or their trajectory of their sales growth and how they're going to drive it. Most people felt pretty comfortable with their operating expenses, although obviously there's going to be some questions there as well, especially for certain types of products. So I just want to say all of these are really difficult to predict. And that's totally fine. One of the ways that we find it really helpful is to use a product roadmap. So we're running a little bit short on time. I want to make sure that we have enough time for the Q&A. I just have a couple of more slides. So if you're able to stay on for a little bit longer, that'll be great. Okay, so here's an example of a lean product roadmap. Because so much of your pro forma is based on your own hypothesis, you want to be able to back these up with a lean product roadmap. The product roadmap should demonstrate how the product is going to attract new users as it's more fully developed, including new features that broaden your demographic, new strategies that increase viral growth, new integrations or partners that might introduce the product to their audiences, and new systems to measure the impact of all of these changes and optimize for those with the greatest potential to increase revenue and profit. So let me just explain this form a little bit more deeply. So in the new features here, new features are going to offer, are going to make your product more useful for a broader demographic. So maybe your initial demographic with your MVP product, your minimum viable product, was really for people in dentistry, but as you add new features, it's actually really applicable to the broader medical field. Great, so that opens up a new market, and that might be something that is then represented in that growth. Okay, stickiness. So this is reducing churn and keeping people in the product, and then not just keeping people in the product, but attracting new people to the product. So one of the things that's on this specific product roadmap and stickiness is promotions, right? So a reward progress bar. So that might be something like we are, like for every client that we bring on, we expect that they will bring in an additional 3 clients because we're giving them 3 months free of the product when they do so. So we can then see that playing out in the pro forma, right? Integrations. So you might be specifically integrating with existing products. And when you do so, your product then becomes more useful for people who are already using that product. And it introduces your product to people who have an interest in what it is that you're already doing. The last one is infrastructure, and that's really taking a look at what's already working, what's not working, measuring it, and then optimizing for that so that you can discontinue the things that aren't working and really put more of your energy, effort, and resources into the things that are. That's really why we find metrics to be so important. If you are interested in talking more about metrics, awesome, I would love to. And I'm having another learn-in next Thursday on metrics. So we can dive deeper into the product roadmap at that point, and I hope that you'll be able to join us. Okay, so before we go, I just want to share some things that I have found to be really useful. People always ask, so I always put this slide in. So I assume that you're already working from the lean startup. I'll be honest, I would not invest in a company that's not using this methodology. As far as I'm concerned, if you're not lean, you don't have a startup, you just have a money pit, and I don't want any part of it. The other books that I highly recommend are Leapfrog and Traction. And then my Bible is really the Lean Product Playbook. Dan Olson is in the South Bay. He runs an excellent monthly meetup that I highly recommend. And you can subscribe to his YouTube channel and hear from past speakers. There are lots of subscriptions that you can get. One of my favorite newsletters for founders comes from First Round Review. I think that they do a great job supporting their founders, and they shared those lessons out through their regular newsletter. I also follow the Long-Term Stock Exchange pretty religiously. That's put out by Eric Ries's company, Eric Ries being the author of The Lean Startup. Long-Term Stock Exchange has really great resources both for founders and investors. Investopedia has great products. When I was early on getting into this, I subscribed to their daily newsletter where they would just send a word a day, and learning the vocabulary alone was so helpful. And then every VC and startup SME has a podcast, so I highly recommend tuning into them. But the most important thing I think that you can do is to get involved in the community. Because if you don't already know 100 investors, how do you expect to be introduced to them? The best way to do that is to join the network, contribute to the success of others, show up, support people. I promise you this will pay dividends later. That's what I wanted to share today. In the Q&A, if you will please write one thing that you learned and one thing that you still have a question about. And if you're not able to stick around, I'll follow up with Isis and Maria and share answers to those. Okay.
Lauren, thank you so much. Can we take some questions right now from the Q&A?
Sure. Okay, I've just opened up the Q&A. This is my first time working with the Q&A. So if you have any suggestions, Maria, for how to go about.
Absolutely. Well, I would actually say let's start with the Q&A box, and Isis and I have actually been collecting questions from the chat as well. So what we can let attendees know now is that if we don't get to your question, it's likely that we'll send all the questions to Lauren and we can get those answered. We have your names as well as to who asked them. So Lauren, I'll hand it to you. And just to let everyone know, we will end at 11, and the three of us will stay on a little bit longer if there are additional questions that Lauren can answer now. But to respect everyone's time, we will end at 11 and kind of do an informal few more minutes, maybe 3 to 5 more minutes to stay on.
Great. So I'm going to start here with Jolynn's question. Best pricing suggestions for new products with no competitors. Okay, everybody has competitors, everybody. So if you don't have competitors, then your product isn't solving a problem. Your competitors, though, might be something totally different. So, what are people right now using to solve the problem that your product addresses? Those are your competitors. They might, you might be creating a software and there is no software out there that solves that problem, but somehow some people are figuring out some other way to get their needs met. And so that's what we think of as your competitor. I hope that makes sense. And Jolynn, if you want to have a longer discussion about that, I would love to know more about what it is that you're creating, and we can chat. So if you'll follow up by LinkedIn, I would be glad to continue to have that conversation. How does the projection change for hardware companies working with the government? Okay, really interesting question. Does the projections change for hardware companies working with the government? So it doesn't necessarily change in terms of the projections. What you want to think about is what their buying cycle is. So when we go back to that question of what does it look like? How do they currently buy? Every department has their own procurement schedule. And so there are only certain times of year that they can make purchases. There is a certain budget above which or below which they're not going to be able to. So you want to learn what it is, you want to learn the buying schedule and cycle and limitations of the government agency that you're specifically going to be working with, and really understand what their process looks like. And again, it's going to be different for every agency in the government. So it's not always the same. Sometimes, they're going to need your product right away, as we're seeing right now with PPE. Sometimes your product might be just like, honestly, a filler product. They have some space in their budget and they need to spend down their budget. So they're going to be spending with you this year. It just depends. How do you create scenario-based projections? I would say that you want to do 3 or 4 or as many as you can. So when I asked you to duplicate the tab 2 of the pro forma, with one of my clients, what we did, she had a fintech app, and we took a look at what the pro forma would look like if she had a B2B business, and then we did the same thing with the B2C. And with her B2B pro forma, she was able to land a pilot with Citibank. And with her B2C pro forma, she was able to land an investment from Science. So what that tells us is that different people are going to look at your product and look at your pro forma and see different opportunities and risks. Those are both great companies, but they have something different to get out of your product. So they're going to be, as investors, they're going to be looking at your product differently. So some scenario-based projections, you might want to look at, okay, what does my product look like B2B versus B2C? What does it look like if I start B2B and then use B2B to open up a B2C market? So you might think about all of the different ways that you could connect with clients, that you can sell, and what it is that looks like in different structures. So how do you prioritize the different aspects about the product roadmap and quantify it with money and time? Andres, that's a great question. And we're going to get deeper into the product roadmap next week. But just to give you a little bit in terms of the product roadmap, we're really talking about metrics and what it is that we're going to test to get a better understanding of what that metric is going to be measuring, and then how we can optimize to grow revenue, to grow users, to decrease costs over time. So different aspects of the product roadmap might be prioritized differently based on the potential of that test to result in a greater increase in revenue or number of users, whichever the metric is that you're most trying to impact at that time. So if you're looking at, if you have a B2C product, your traction is going to look really different than a B2B product, right? Great traction for a B2B enterprise SaaS might be 3 really great customers, whereas a B2C app, you might need 20,000 customers. So with your traction there, and being able to show traction and then really increase user acquisition and then associated metrics around that, those things are going to play out in your product roadmap. And that's where we're prioritizing different aspects across your timeline. I hope that helps. Let's say I'm building a prototype web app for $6,000. How would I convert that into a cost per unit? Okay, so there, your cost per unit, if you are building a prototype web app right now, your cost per unit, if you have 1 customer, the cost per unit is $6,000. Right, so you want to show that with $6,000 you can get X number of users based on your MVP feature set. So again, this is an estimate. This is your hypothesis. How many people are going to be able to, or interested in, likely to purchase that product? when it has that MVP feature set. And that's really going to be, you know, at that point, your thesis for the cost per unit. That is all. That's going to include new features as you go. So let's say you start with 6,000 and then you are increasing the investment in the app, but as you increase the investment, your user acquisition is also increasing exponentially. So there you can see it play out and justify the increased investment over time as well. I hope that made sense.
Lauren, this has been fantastic. So just to pause right before 11 o'clock so that those of us that need to hop off, those attendees that need to hop off can. Thank you all so much for attending. If you need to hop off now, we will continue for another few minutes. And Lauren, thank you so much for sharing your insights and all of your knowledge with our community.
Wow,
so for those of you that do need to hop off at the moment, please fill out the survey to let Lauren know that you loved her presentation. Isis will post that in the chat channel, and please fill that out. That's so helpful for both Lauren and the NASDAQ Entrepreneurial Center. And Lauren, I'll hand it back to you. I think perhaps we can do one or two additional questions and then we can all hop off.
Sure, thank you.